Chris, is everybody in?
As of right now, yes.
Perfect. So let's go ahead and get started. First of all, I want to welcome everybody. I know we have some new folks here. So for those of you who don't know me, I'm Carrie Pugh, founder and lead financial advisor here at Fusion Financial Group. Certainly excited to host everybody for, I think this is our third lunch and learn event. We know that everyone is super busy and we like to keep that lunch hour real focused on the learning aspect. This year, of course, markets have certainly kept us on our toes. So we are absolutely thrilled to welcome Dr. Jeff Roach. He is the chief economist at LPL for our research team. Many of you know that I am a big fan of all things LPL Research. It's an amazing resource for us as advisors to be able to dial in to our own in-house research team. So especially when things started on that downhill slide earlier this year, we get really quick information that we can very seamlessly pass down to you. And of course, for those of you on some of our LPL platforms, we use LPL Research to also help with integrity of the portfolios that we build as well. So joining us from the Charlotte, Carolina, right, Jeff? I got that right? Yeah.
Right.
I'm going to zip it at this point. I'm going to turn it over to Jeff to give us an overall market update. A lot of great information here. So take notes. We'll open up for questions towards the end. So with no further ado, Jeff, please take it away.
All right, Carrie, thank you for the privilege of addressing your clients and team. And I will be pretty crisp on my views on what's happening and how to think about it, some of the hot takes of what's going on in the markets. But I certainly do want to make sure that we have plenty of time for Q&A because I'm going to highlight four of my hot topics, but that's only four. There's probably 1,001 hot topics that we could discuss. So that's the value of Q&A. I do love hearing from end clients and those on Main Street. For those of us on Wall Street, we want to make sure our roots are strong and true to the main parts of America on Main Street. So that being said, let's dive in. I started my career on the trading floor at Bank of America in Charlotte, and I am in Charlotte now after a brief stint in California. And I'll say that some of the hot topics here have to start out with growth. We will talk about Fed and tariffs and US exceptionalism, but my first hot topic is growth. And the reason why that's so important is because growth expectations and the trajectory have everything to do with building right expectations on how companies are expected to perform relative to how their prices, the PE, all the forward earnings guidance, all of the fundamental data that we track on an equity standpoint and even fixed income standpoint goes back to growth expectations. And of course, when I say growth, it's made up of consumer spending and capital expenditures from the business side and investment and equipment and trade, both imports and exports. And we call that gross domestic product, but I'm not going to bore you with that calculation. I just say, everything that we're producing in the economy, we call growth. So I think a recession is becoming more likely, but not inevitable. I think that's really a strong point to make. It's not inevitable that we're going to be in a recession soon. And when I say recession, I don't mean what is incorrectly stated often in the media, and that is 2 quarters of negative growth. Unfortunately, we've seen recession where it's not been 2 quarters, and we've seen 2 quarters of negative growth with no recession. So we've seen both sides. But I will say that what we're seeing now, here we are, middle of May. Amazingly, it's middle of May. 2025 is flying by. Really similar to 2022, where we had a lot of negative growth, a lot of negative numbers when we thought about the economy, but it was all about trade because of the supply constraints. In fact, during that time, I was in Silicon Valley working for Visa as an economist for the global team, and I physically saw all those container ships floating off of the port of Oakland and San Francisco. And when I went to Southern California, floating off the coast of LA and Long Beach, seriously important ports for global trade. And we had a bunch of floating imports. They couldn't even get to our country because we couldn't unload them. And then we couldn't truck them into storage. And then we couldn't truck them from storage to retail business purchasers. Well, we had negative growth in Q1, negative GDP, gross domestic product, but that was all because in March, businesses started to stockpile inventories in anticipation of the unknowns of April and the announcements on trade policy. So we actually had a pretty serious slowdown in January and February, and then this massive reversal in anticipation of, hey, we need to get our stuff now and stock up inventories now and bring imports in now before it's too late. Hence, that was one of the reasons why we had some really unusual numbers for March, and that pulled down growth. I don't think that we're in a position, again, where recession is inevitable because the consumer is still really strong. In fact, we're seeing that from some of the Q4 numbers, and then some of the conversations even in the last couple of weeks when we went through earnings season. Particularly the middle and upper income consumer is still spending pretty well and not necessarily defaulting on debt. It's the subprime sector that is starting to show some defaults and some delinquencies, particularly in subprime auto loans, but it's not uniform. And that's one of the reasons why we think that recession is likely, but not inevitable. And hence, that's, I think, one of the reasons why we're seeing a stock market recover so quickly after some of the really weird and strange events from the beginning of April. The S&P 500, I'm looking at my screen here to my left, we're almost up to 5,900. So we're not actually too far from above the highs that we saw earlier this year, and we're positive for 2025 as a whole. Part of that is due to the fact that the consumer, particularly the middle income and upper income consumers, are doing okay. Now, I say okay because we're holding steady. So recession, likely not inevitable. That's my first hot topic. We can talk about it more during Q&A. Second hot topic is on Fed independence. I think it's really important to kind of think through that. And one of the things that's been really a big catalyst for yields moving around all over the place this year. So this second hot topic is Fed independence. Interestingly enough, not many people know this, but Carrie, I thought this would be kind of fun for your end clients. The Federal Reserve is not the first iteration of our central bank we've had in this country. And in fact, it's not even the second iteration. It's the third iteration. So we had a Bank of America under Alexander Hamilton, 1791, lasted for a couple decades. Then the charter expired, and we didn't renew a charter until 1830s. Then that expired, and in the 1860s, all the way to 1913, we had no central bank. It was 1913, third round. And what's interesting, this is the reason why it's a hot topic here, is in 1913, in the Federal Reserve Act, there was a provision for the president to can the chairman of the Federal Reserve Federal Open Market Committee for cause. And of course, the reason why this would probably go to the courts is, what's the for cause? And at this point, there is no reason to fire, but there is a little bit of ambiguity in that 1913 act. But more importantly, and this is what's kind of fun for those that are on Main Street, the way that our Fed is constructed is extremely American. It's unique. It doesn't show up anywhere else in the world in other central banks. But even our central bank system has a very strong democratic representative form to it. Again, unique to America. And that's this. And it has everything to do with, you're not too far, Carrie, from Denver. If I remember correctly, I've met you in person at some of our LPL conferences, not too far from Denver. We have an open market committee that sets interest rates. Half of that committee is board of governors. That's approved by Congress, nominated by the president, approved by Congress. But the other half of the committee are presidents of district banks. We have 12 district banks in this country that make up the Federal Reserve System. And those district banks are actually governed by independent boards of private citizens. In fact, LPL has a relationship that's connected to one of those 12 branches because we have a deal with a regional bank in the Southeast, and their executive vice president is on the board of one of the district branches. So it's kind of fun to make that connection. Very, very American in the sense that every region of the country is always represented every time the Federal Open Market Committee meets and makes decisions on interest rates. I just like saying that because I'm a proud American. And I like to remind folks that even in our central banking, we're very American. But Fed independence is key to a fully functioning capital market. And I think that's the second hot topic is whenever that's at risk, that would be a catalyst for volatility in the markets. And we started to see that, of course, with some of the chatter. Now, granted, I think we've moved past that, hey, cut rates or I'll fire you kind of rhetoric. I think the markets have moved past that. I think investors have moved past this because that it's not necessarily easy to do because there's no reason for cause. Now, again, if Chair Powell does something crazy, we might say, okay, well, there's a for cause reason for his removal. But at this point, I think investors have really moved past that kind of rhetoric. So second hot topic is Fed. And the Fed's in a tough spot because growth is slowing, but inflation is still running hot, particularly in the services side of things. Think insurance, think housing, renting, that kind of thing. That's the challenge. Hot take here on the Fed. Third, of course, is tariffs. I have to talk about tariffs. Then I'm going to talk about U.S. exceptionalism. Then I'll open up for Q&A. So hang with me here. And I apologize in advance if I make it feel like this is Econ 101 college days all over again. But you're staying awake. That might be the difference in this econ class than your econ class in college. So tariffs are not good. I think pretty much everybody knows that fundamentally, but it is fair to say tariffs are a tool. I actually would say tariffs fundamentally are a tool when you talk about humanitarian components. So, for example, I think if I were president for the day, I'd say, okay, tariffs could actually, I would use tariffs potentially as a tool to do two things. One is to address what I think is terrible labor laws in emerging economies. I'm not interested in 7-year-olds working on a factory line. Okay, tariffs could actually be a tool in which you address those kinds of things, which I think is important. We care about our fellow neighbor, whether it's across country lines. So tariffs could be used in that kind of humanitarian component. I think also equally important, I think it's fair to use a tariff tool to say, look, our country is unique because we protect intellectual capital. So property rights, intellectual property rights are very important to us. I lived in Silicon Valley. I loved living in Silicon Valley. I didn't love the price tag of living in Silicon Valley, but I love the idea that our country's legal system has a way in which to protect entrepreneurship and creativity and innovation. And if there is a risk that other countries reverse engineer and take profits from what should go toward the entrepreneur, I would say, hey, tariffs might be a good way to use that tool. pretty much anything else, I don't think is a good use of tariffs. I think we learned that from the 17th century, David Ricardo talking about comparative advantage. One country has to do one thing good relative to another thing. You should farm out the things you're not relatively good at, focus on your comparative advantage and gains from trade. Now, recently talked to some folks about this. I said, well, in some ways, trading relationships are like a marriage. There are inherent vulnerabilities in that. Within a marriage, within a trading relationship, there are vulnerabilities. We certainly saw the vulnerabilities when we couldn't get supply chains working correctly during the pandemic. So one way in which to say, okay, maybe there should be some rethinking about how you use and how you calculate the risk of an international supply chain. But I think, tariffs fundamentally are not good. They are not, I say they are not good because trade deficits are not bad. And that's kind of the key takeaway, saying, okay, just because we have a deficit with a country doesn't necessarily mean that's bad things, because that means investment is coming into our country. So let's go past the philosophical and get to the practical. I think what we're seeing in a real-time fashion is that the administration is very willing to walk back the extremes that were originally stated in early April. We've seen this multiple times now. We've actually saw it in Trump 1.0. We saw him walk back and provide thousands of exclusions in 2018. You can pull that up, look up the U.S. Trade Representative site online and see all the exclusions that were in place for 2018. We're seeing the same thing in many ways now, a walking back of the extreme case, an allowance for a lot of exclusions. And I think what that's doing is saying, all right, we're not gonna live long term with some triple digit tariff rate, and not even triple digits. In fact, I just blogged on something, Carrie. I know you're a fan of LPL Research. One of the things which is kind of fun, if you have insomnia, you can go to lpl.com, go to that research tab. I just blogged on what it means with the announcements over the weekend with US China and how that changes effective tariff rates. One thing I think that markets have correctly interpreted, and this is my summary on this third hot topic, is that the administration is consistently, regularly walking back some of his extreme views, and that's certainly good news for investors. I will say one final footnote before I go to the fourth hot take here, and that is this. In some ways, businesses have rethought trade years ago, particularly 2022. So in some ways, we could say, hey, this tariff debacle of April, May, it could have been a lot worse if this were done at that extreme level during Trump 1.0. Given the fact that a lot of businesses have already worked on diversifying because of 2022, a lot of businesses are in a better shape. Now, granted, those are larger companies. Unfortunately, smaller firms don't have the flexibility and just the ability to change suppliers in such a short order. Unfortunately, tariffs are, I think, in my view, are hitting smaller firms and small cap firms. Hence the challenge with small cap exposure harder than large cap. Okay, let's go to my fourth hot topic, and then open up for Q&A. We can talk about anything you guys want. Truly, fourth hot topic is this. And it has to do with this phrase that we've used and we've seen in the media a lot, U.S. exceptionalism. I think that's a little bit confusing, but I'll explain what I think it really means at the heart. And it goes back to really the 1960s. We had a prime minister, or I guess a Ministry of Finance in France, talking about the exorbitant privilege of the dollar. The US dollar was still the reserve currency of the world, despite the way that we've had such deficit spending. Of course, in the 60s, we were still working through post-war kind of dynamics, which, by the way, this is another, maybe a sub point over my fourth hot topic. I think the post-World War II economy is really helpful in understanding the post-pandemic economy, because there's just so much flux, so much moving around. Think about Cadillac, for example. Cadillac was not making any Cadillacs. They were making M1 light tanks for the Allies in Europe. And then you had this massive shift again. Pandemic kind of did that for us. We had this massive shift in labor and capital, and that has taken years, and structural shifts happen in the economy because of that. Same thing with post-World War II economy, just like that post-pandemic economies. But U.S. exceptionalism refers to this, the fact that despite some of the weaknesses inherently with how we manage federal spending, we still see a really strong presence of the dollar as a reserve currency. Now, granted, that's come down since the last decade or two. Global reserve currencies are something that central banks hold, sovereign wealth funds hold, large insurance companies hold, and the dollar is about 60% of all global currency reserves. That's impressive. Now, 2 decades ago, it was 70, down to 60, but that's still a reason to say, all right, I don't think U.S. exceptionalism is going to change overnight. Maybe over a few more decades, but not overnight. And that's because of this. Key takeaway, I think, to keep it simple here, key takeaway here is this. You have among the largest stock exchanges in the world, the largest is New York Stock Exchange at 35-ish trillion market cap, right? 32-ish trillion market cap. The second largest, still over 30 trillion, NASDAQ. So those two are over 42% of the world's market cap in terms of stock exchanges. The third one, it goes from the 30s level down to 7, and that's Shanghai. And then you go Japan and et cetera, Euronext. So just the fact that we have by far and away the broadest and deepest capital markets in the world by a long shot, that's giving us a little bit of time, as it were, to continue benefiting from what is truly the exorbitant privilege of the US dollar, or this US exceptionalism, the breadth and depth of the capital markets. And then secondly, the quality and the protection from our legal system. The property rights is unique in this country, especially relative to emerging markets. So U.S. exceptionalism could change, but not anytime soon. Maybe the next generation or two. That's certainly something to think about as a risk, and that's why it's a hot topic, because we're seeing yields on the 10-year trading. I'm looking at the numbers right now. We're at 452 on the 10-year. So that is an okay level. We certainly don't want to see those yields go up to, say, 5. But in that 4.25 to 4.5 range is certainly the upper range on the 10-year. But it does give a little bit of pressure on fixed income. So I'll end it there, Carrie. A lot of things to talk about, but I thought, well, I'll distill it down to some of the 4 items that I'm thinking about, and then be glad to discuss truly anything else you want.
Perfect. Well, I definitely appreciate that. We did have folks send in questions ahead of time, so I have a couple of those maybe to kick us off. And I do welcome, I think everyone is muted, but you should be able to drop a question in the chat if you want to add to it. Because please do remember, let's not call Chris and I tomorrow to say, I was on the meeting and Jeff said this. What do you think about that? So we have our expert here for a reason. And please don't be shy, ask questions. But I'm going to pick one that I feel like we get questions on all the time. And certainly with what some of the activity that Trump has had as of late is, will crypto eventually be the only currency that is used?
Oh, great question on the crypto, which before I answer that, I will give you a book recommendation. I always enjoy when people say and share what they're reading. I just finished Michael Lewis's book called Going Infinite, and that's about Sam Bankman-Fried. And Michael Lewis, of course, is very famous for Moneyball, Flash Boys, a lot of these hedge fundy kind of. In fact, didn't he write? Carrie, you might have to help me. There's a Blind Side, didn't he? Wasn't that based on one of his books, the Blind Side movie? Anyway, don't want to put you on the spot, but um, Michael Lewis wrote a book on Flash. Sorry, I said Flash Boys. Going Infinite. That's the title name. Sam Bankman-Fried. Sam Bankman-Fried, of course, is infamous for his Alameda Research and FTX crypto platform. The value of that book, and this is what I appreciated, is we don't have the structure for crypto to really develop to truly replace other currencies. And you think about, I was at Visa before LPL as a head economist and looking at trends in the global markets, but I was doing that for a technology company. Don't think of Visa as a financial services company. They were a technology. In fact, they're in the technology space, NASDAQ, or technology sector, because Visa is all about the plumbing of the payment system. How does a payment go from one place to another place, and who bears the risk, and how to make that payment move efficiently. So cryptocurrencies don't have a healthy plumbing system, to use the same analogy. Who knows about 50 years from now, but you have to understand that what has to happen first before you look at some of the private cryptocurrencies and blockchain currencies, and there's thousands of them. Bitcoin is just one, but thousands of them. I think the biggest chance, the highest probability of something actually developing into something meaningful is something that the Bank of Switzerland has worked on pretty well. And that the Bank of International Settlements based in Switzerland. And that's these central bank digital currencies. If you want more detail on that, you can Google it. Central bank digital currencies, CBDC for short. Google that and you'll get some really interesting things. Basically, the Fed and Treasury, the global payment system, if it's going through if a digital payment is going through the plumbing of like a central bank that exists efficiently and safely, that could have a chance of going somewhere. But right now, no. It's in essence, it really just be a digital dollar. So not replacing the dollar, but maybe another improvement in iteration upon the dollar that we use even today.
It's actually a great analogy. We try to break things down with those very solid visuals here to really try to explain extremely complex concepts. So plumbing and the movement of that completely resonated with me. Chris, I don't know if you want to. I know a couple of people threw some questions in chat. Do you want to take some of those? And for those of you who don't know Chris, I imagine almost everyone does. Chris has been at Fusion basically since we started. He just celebrated his 5-year anniversary here, which is super exciting. So he is also the secondary advisor here on our team. He helps a lot, as you guys know, plan construction, portfolio construction, and also a big fan of LPL Research because he does support us in due diligence and research as well too. So Chris, I'll turn it over to you to see what's going on in the chat function.
Thanks, Carrie. And yeah, one of the questions was on gold. So what your thoughts are there and other precious metals potentially.
Yeah, gold had an incredible rally this year when people were concerned and nervous, which is a very normal thing to do. You do see that relationship when you have folks that are uncertain of your traditional equity bond opportunities, looking for alternative exposure. I don't know if there's much more room to go to the upside, but it certainly is very logical to see the rally in more recent months. So I would say, very practically, I wouldn't be a buyer of gold right now. Certainly worth holding on to. If anything, maybe trim some of that exposure if you have some, and diversify across to other asset classes. But gold is often that case, not necessarily what traditionally we used to say a hedge against inflation. I think it's more of a hedge against uncertainty, and that's certainly what we've seen over the last little bit. And that's, I think, gold has acted just like it should act, if I could say it that way.
Perfect, thank you. And everyone is able to unmute if you do feel better just asking a question. You can unmute yourself and ask. And then another question here is, do you see the tariffs fluctuations as a manipulation of the market?
Yeah, it's a good question. I mean, clearly it is shocking the markets up and down, right? Bad news, market sells off. Good news, market rallies. And I think it's possible to say, fool me once, shame on you, fool me twice, shame on me, to get that kind of, reaction. Perhaps there might be a time where eventually markets kind of move past the headline risk. I will say, by the way, good question about just the manipulation of markets. I think it's helpful when you think about just the incredible movements off of headlines. It reminds me to say, you don't want to think of yourself as a trader. You think of yourself as an investor, and not try to play headlines. That's the value of an advisor, that financial shrink walking alongside of you, perhaps helping you work through the emotions of the headlines, but being careful not to have knee-jerk reactions to the headlines. Headlines do move markets, though, hence the value of being mindful of that, and again, careful not to fall into the trap of trying to play those headlines. Listen to your advisor who knows your goals and knows the details of your family and family desires and such. Certainly a better person to listen to than headlines.
Thank you. And you talked about the Fed. What are your thoughts on, for the rest of the year, rate cuts and how that'll play into the market and the economy?
Well, actually, that's a good follow-up from the comment I just made about not playing headlines. Look past just today or next week or even next month, or what happens after 90 days pause. Think next year, think end of this year. So that's how I'll answer your question on Fed. Here we are mid-May. I think it's fair to say by the end of the year, if we're sitting around a Zoom call in December, I think it's completely reasonable to expect rates to be lower by the end of the year than now. I think the Fed still can say inflation is going in the right direction, not as fast as we would want, but the Fed can say, and I think without a shadow of a doubt, the data are showing both a softening of growth and a decelerating of inflation. So maybe they don't act in the next month, but they will act by the end of the year. So rates will be lower, and of course that does translate into your retail rates. Think prime, think mortgage, think auto, think home equity. Eventually, that does indeed, from the Fed activity all the way to the retail rates. I think across those, rates will be lower by the end of the year.
Thank you.
Another pre-submitted question here. Do we want to pause? And why don't we pause? Would anyone like to unmute and ask a live question before we keep going through chat and pre-submitted questions?
I would. Can you hear me?
Yep, I can hear you. Go ahead.
Hi, Jeff. Thanks for coming on. So, like yesterday, Saudi Arabia just announced the $600 billion investment in the United States, and all the other countries that have promised investments. Is that a good thing? Didn't that come from tariffs?
It came fundamentally from trade deficits, which is related to the conversation about tariffs. It's a good thing in essence that it's tying our trading partners to be incentivized for our success. You could think of it that way. Now, granted, like I said, it's a great analogy to think international trade is like a marriage. There's benefits, but there's certainly vulnerabilities, and that's very important to think through. But I think, in essence, if you're creating a structure where someone else is incentivized for your success, that's fundamentally a good thing. If you think about it on the individual level, if I win when you win, then our incentives are aligned. That's fundamentally a good thing.
Would that have ever happened if we didn't have the tariffs?
Maybe it would happen when you have a trade deficit, right? When we're importing more than we export, meaning that our trading partner has a bunch of US dollars that they have to do something with. And in essence, that's an incentive to say, hey, let's use those dollars that you just gained from our trade imbalance to put back into the US as a US investment. That is a normal cycle of things. People don't think about it, and I'll give you one little technical nugget that you don't have to remember. No pop quizzes. When you think about trade balances, imports, exports, everybody knows about that. But there's a corresponding accounting balance called the capital account. There's a current account and a capital account. That's the flow of dollars. So we have a flow of goods and services. We have a flow of dollars. Fundamentally, we as right now, the United States has a capital account surplus. And that is what's the driving force of an investment, as you just said. A tariff, in essence, might be kind of a catalyst to nudge our trading partner into pushing investments into this country. And hence, that's why I use the reference of maybe legal protection of intellectual capital or even humanitarian components. Tariffs can certainly be catalysts in terms of nudging our trading partners to do something. And that's a fair analogy.
Okay. Thank you.
You're welcome.
Would anyone else like to ask a question before we go back through some of the ones in chat? All right, so I think we touched on this, Jeff, a little earlier, but I want to make sure I ask it again. Is it true that more foreign countries are moving away from the dollar?
There are some emerging countries, particularly China, that are diversifying their dollar holdings. And so, as I mentioned, over the last several decades, you're seeing maybe a diversification. I wouldn't say a moving away, because there's still such a vast majority of global currency reserves truly everywhere around the globe, both in emerging markets as well as developing and more developed markets. Think Germany, think Japan, that still have a lot of dollars. In fact, that's still the majority of their portfolio. You can think of it this way. If in your own portfolio, if you're moving from a 70% exposure to equities to a 60% exposure to equities, you're still pretty exposed to equities, meaning, hey, I want exposure in this section. You're diversifying and managing risk. And I think that's kind of the fair way to look at it. There's still overall a fairly healthy demand because of the breadth and depth of our markets.
And last one that I have that we have pre-submitted is around the slowing economy. I think I know what you're going to say here, but I'm not sure. I don't want to speak for you, but concerns there, but we're a slowing economy. Is that a bad thing?
So I'll answer it with a little bit of history. Since World War II, we have a recession in this country every 5.5 years. And those recessions last about 10 months on average. So I've used this analogy before. Recessions are never a good thing, right? We're living through a contraction is when we have a recession. Recessions are not depressions, and then hence you could almost think of a recession as part of the business cycle, a retuning, if you will. Think about going into a symphony orchestra concert, and before the concert starts, the oboist or the concert mistress stands up, plays their concert A 440, everybody tunes, but for a while it sounds horrid. You think, what? If it's a kid you've brought for the first time, you think, wow, that's a really weird sound, but they're tuning, and then of course they make beautiful music. In some ways, recessions are indeed like that, where there might be imbalances. There needs to be a reset of certain things. Think about this: before the great financial crisis, was it healthy to have a mortgage market where if you could fog a mirror, you could get a mortgage? That's not sustainable. No doc loans. And you talk to people that are younger, and you think, hey, do you think a no doc loan is a good idea? They'd be shocked that we actually had that for several years in this country, in the way that where mortgages were no documentation or no income verification type mortgage loans. Crazy. We needed a reset in that sense. Do we have to have recessions? Well, of course not. But in some ways, it is an opportunity to say, okay, what are we doing that's just not sustainable, and rethink. And in some ways, we're kind of due for a recession or a slowdown, if you will. I think it is possible that we could have perhaps that so-called soft landing. But we shut down in 2020. We had supply chain problems 21, even in 2022, 23, 24, economy was growing at breakneck speeds. Here we are, 2025. We're certainly due for a slowdown to say, okay, we spent like drunken sailors. Let's think about other areas of the economy to repair. And I think that's where it's fair to say a resetting of expectations. Can we do it without a recession? Well, that certainly would be preferable.
Great. Good. Chris, anything else from chat group or pre-submitted questions on your side?
I got one more pre-submitted question, so put you on the spot here.
Uh-oh.
So we had the housing crash, we had COVID. If you saw one black swan event that keeps you up at night, what would you say there could be out there that could bring the market down?
I would say the biggest unknown and biggest impact would be something that comes internationally, that maybe there's, major international players that might coordinate to do something to take us down, if you will. Maybe through the bond market, something like that. That would be kind of the black swan event. From a fundamental standpoint, we know that businesses have cash on their hands, and they've actually told us before the election they were waiting to make capital expenditures and investments for their companies until after some resolution of the elections of November. I think they're still sitting on a lot of cash. So the corporate balance sheets are pretty healthy. On the consumer side, it's a little bit more mixed. Lower income folks feeling a lot more pressure than, say, middle and upper income, but the economy is being driven right now by the middle and upper income. So there's still there's trillions in money market funds and checkable deposits. So a lot of cash on hand from the consumer side. So when you think outside of the economy, that's where your international components come in. That's probably the biggest risk. Maybe something happens internationally that ends up having some ripple effects on the US. So, think Japan, think Germany, think United Kingdom. Those are your stable countries. And then you're less stable, think Argentina, maybe, or Brazil, or China, or Russia, if there's some kind of unusual sovereign debt default. That would be something that we look at in terms of being an early warning sign. So that's always a good thing to say, okay, if you got a black swan event, what can you do to help anticipate looking at default risks at the sovereign level, at the country level? That's something we're tracking if there's any uncertainty and risk there. At this point, we don't see rising default risks at that level, but that would be something to look out for.
Thank you.
So I know we're kind of coming up on time here. While we have Jeff, any other questions from the audience? I'm going to take that as a no, but again, don't call tomorrow and say I had another question. I am an eternal optimist, maybe to a fault. I have younger kids, so I like to think about the world as far as innovation and the possibility, and all of us continuing to raise, talk about getting philosophical, raise the quality of life for ourselves, our families, and our global community. So I'm going to flip from what Chris asked and ask if there were some glimmering bright spots that you would see. Not that I think we're in a bad space. I agree with some of this being pain that has been due. Bright spots that you see going forward as well for us.
Well, we saw in the first quarter of this year a fair amount of investment in AI, artificial intelligence, and everything related to it. So just the innovation in this country is still pretty impressive. We're not necessarily at a plateau yet. There's still a lot of interesting things that are still in the development stage, if you will, meaning, we haven't even fully tapped, just not even the beginnings of some of the opportunities that we see that will make our lives better and let it better for our children. So I think that would be one of the biggest bright spots, I think, in the globe. And what makes me pro US is that you really see a lot of the creativity globally focused in the US, or at least concentrated in the US, within the US. And so that's certainly a good thing for our economy. That's a good thing for, the next generation. And that's something that provides, I think, the glimmer of hope that you asked about.
Good. Chris, anything else?
This is great. Thank you very much. Yeah.
Good. So being mindful of everyone's lunch hour, I think what we'll do is go ahead and wrap here. I just want to say, Jeff, thank you so much for spending the time to come in and join us for this virtual Lunch and Learn event. I think that you touched on some great speaking points, and for me, even left some great visuals as well, too. We definitely appreciate it.
Well, you're welcome. Next time we can do this in person, as long as it's in ski season when there's plenty of snow. That's a good excuse to get to Colorado.
We'll see if we can figure that one out for sure. So, perfect. Good, everybody. Well, thank you so much from the audience for taking the time to join as well, too. And we'll certainly look forward to connecting with you. And of course, partially kidding, not kidding, as you kind of think on what Jeff shared, feel free to reach out. We're always happy to have a meeting, or call, Zoom, what have you, as you know. And of course, if we need to check back in on how does some of this make us feel about our goals and our financial plan, we're always here to help support further conversation there too. Perfect. In that case, then I'll let everyone back to their day. And again, good to see so many faces, and thanks for the time, everybody.
Take care.